Thank you everyone for joining us for our webinar today with Peter Brandt of Factor LLC and Axel Kabar of Tech Charts. My name is Jolene Olson. Outside of this webinar, feel free to email me if you have any questions about your membership for either service. I can help you with that. If you have any questions for Peter or Axel during the webinar, please write them in your questions panel on the bottom of your GoToWebinar control panel. If your question is specific to Peter or Axel, we are asking that you please write their name in front of your question so it can be directed towards them. If you notice you're having any audio or video issues during the webinar, I recommend closing out of the webinar and logging back in. And now I would like to welcome Peter and Axel.
Thanks, Jolene. Can you hear me?
Great, Peter. Nice and clear. Thank you.
Oh, yeah. Hey, thank you.
Great, great. Hi, Axel. Welcome, welcome.
Hey, thanks, everybody, for taking time out of your day to spend some time with us. We hope it's going to be a useful expenditure of your time and that you're going to benefit by some of the things we cover. Thank you, Axel, for being willing to do this with me. For those of you who, you may or may not be aware, but Axel and I go back. We're good friends, but, and of course, that's important to us. But what really brought us together originally is that we are classical chartists. We believe in the classical sense, and that means that our dedication is to the original work of Richard W. Schabacher. We go back to 1933 and in his book, and then of course picked up with Edwards and McGee in 1948, where they expounded upon some of these classical charting principles. And we both comment on many of the charts we may see today in the blogosphere that, yes, they're charts, but they're not marked up in the classical way that we would look at it. And even within classical charting, Axel and I think a lot alike about what chart patterns are the best for trading, have the highest reliability, and so forth. Of course, Axel focuses on global equity markets. I mean global. He looks at markets all over the world, markets that a number of you probably don't even have access to trading, but he is, in the true sense, a global chartist in the equity market. I look at futures and Forex, and so those are kind of specialties. And so, hey, I'd just like to start off, Axel, by just asking you, what, of all the patterns that Schabacher, Edwards, and McGee really discuss, what are your, let's say, 4 favorite patterns to identify for trading opportunities?
Yeah, sure, Peter. First of all, it's a pleasure to have this joint webinar with you, and thanks everyone for joining today. My preferred chart patterns, people who are familiar with Peter's books will remember that he stresses mainly about the horizontal chart patterns, how they are more reliable. So my favorite chart patterns are the chart patterns that have clear horizontal boundaries, and these are rectangles, head and shoulders, right angle triangles, and cup with handle. Of course, in equities, we have more cup with handle chart patterns forming than commodity markets. So this is also another area that I focus on to identify the cup with handle chart patterns on long-term chart patterns.
Hey, thanks, Axel. We resonate on those, and it's a good point about the cup and handle. That tends to be more of a continuation pattern in equities. Doesn't really appear much in futures and Forex. Hey, of those patterns, could you show us some examples of each, just so we know exactly what you're talking about?
Sure, Peter. So before I start with these examples, I would like to stress a few important concepts that members usually ask some questions about. And I would like to talk about those also with those examples. One of them is the way we draw trend lines. So we try to draw trend lines with connecting as many points as possible. So we might exclude the orthodox tops, but try to connect the candlestick bodies. Another concept that I will be discussing here is the launching pattern, which members might be familiar if they have read Peter's books. Launching patterns with shorter term duration completing the bigger picture with bullish implications. Another chart that will discuss the secondary completion concept, and something that I always look at with the medium to long-term chart patterns is the several tests of horizontal boundaries before breakout. This is something that I pay attention to. And also, I look at chart patterns with length of minimum 4 months up to 24 months. So if you look at, for example, the first example is showing basically 3 different chart patterns here. One of them is a head and shoulder bottom, a 14-month long head and shoulder bottom on BBVA, a Spanish banking stock, that completed with a launching pattern here, which was a 4-month long ascending triangle. The breakout week is here. So the right shoulder of the head and shoulder bottom was an ascending triangle itself. It completed the head and shoulder chart pattern, reached its chart pattern price target, and now possibly we're forming another rectangle which can act as a bullish continuation chart pattern and take us to the head and shoulder bottom price target at 8.6 levels. So on this chart we can see 3 different chart patterns and completing the bigger picture. The second example I have is another ascending triangle, ascending triangle from Switzerland. It's a basic materials company. So this chart, after testing several times the upper boundary, had a clear breakout and reached its chart pattern price target. So it's a clear horizontal boundary with a clear weekly breakout. It was a 10-month long ascending triangle. Rectangles are reliable. They're one of my favorite chart patterns because we can clearly see the chart pattern boundary price bouncing between the boundaries. So here we had EFG International, another Switzerland financial company that had a clear breakout, reached its chart pattern price target. It was a 6-month long rectangle. Another rectangle members will remember was FedEx. So this is a 5-month long rectangle. The chart pattern boundary was tested again several times. This week, here is the breakout week, taking us to the chart pattern price target. It was also a perfect rectangle, well identified. Another one, members remember, I look at emerging markets. I highlight those chart patterns that are clearly identifiable in the emerging markets universe. So this was a company from Peru. It had a clear chart pattern, 8-month long rectangle that had a clear breakout, took us to the chart pattern boundary, chart pattern price target at 8.7 levels. Again, on this chart, you can also see several chart patterns forming before this uptrend started. So it always starts with a base formation. Here we have the head and shoulder bottom. The breakout takes place. We see a nice flag forming here, which was a pullback to the head and shoulder bottom, and then the continuation takes place, and here we have another pause, and now the trend is continuing. Head and shoulder continuation, a widely discussed chart pattern. We see it a lot in equities. I have several examples on the website and on Twitter postings. Here, this was a Japanese company that completed a perfect year-long head and shoulder continuation. What I like about those is there are several tests of the boundary which makes it weaker. Every time we test the boundary becomes weaker, and eventually we see a thrust, a strong breakout, usually followed by a continuous uptrend. So head and shoulder continuation price target was met in almost 2 weeks after the breakout took place. Here, members will remember I highlighted the bullish case for Thailand equities. Thailand index was breaking out, and this was one of the stocks, a blue chip company, that broke out almost the first stock in the Thailand equities and still moving higher with a strong uptrend. Here is a perfect head and shoulder continuation that the boundary was tested several times and a strong breakout took place. and now the uptrend is still continuing. A chart pattern price target can be exceeded because we are completing 14-month long head and shoulder continuation. These are long-term chart patterns that signals a major trend change, major shift from consolidation to uptrend. Here we had another head and shoulder continuation chart pattern with a clear boundary, horizontal boundary that was broken on the upside. We have seen a small consolidation here, a couple of weeks, and then the uptrend resumed. Head and shoulder continuation chart pattern was met again here on this one, Carlyle Group. And the last chart here is a perfect cup with handle chart pattern from UK, a consumer cyclical company, Cineworld. Again, you can see the horizontal boundary, several times test. These spikes are basically the tests of these boundary, and then the breakout week here clears the chart pattern boundary at 600, and then we see the cup with handle price target being met in a few months. So these are the charts that I look. These are the chart patterns that I like to see on equities. And Peter, what about your favorite chart patterns?
Sure. If you hand me over the screen there, Jolene, I'll move to my charts. Well, you know, it'll come with no surprise to anybody that the patterns that Axel like best also tend to be the patterns I like best, and that's clear horizontal patterns as opposed to diagonal patterns, which would be diagonal patterns would be symmetrical triangles, rising and falling wedges, trend lines, channels, that sort of thing. Is my preference over time has come to be really look for these horizontal patterns. For me, that's right angle triangles, which would be ascending, descending triangles, rectangles, and head and shoulders patterns with necklines that tend to either be flat or slanted in the direction of the breakout. I do not like head and shoulders patterns with a neckline that is upward slanting, let's say, for a top, or downward slanting for a bottom. I've found those tend to be patterns that will disappoint me more often than not. Let me just make a couple of points on charting before I look at some of the patterns that for me have been are my favorite patterns, examples of those. And let me just point out that you know, I think Axel and I both have seen that one of the mistakes somebody makes when they come into charting and they say, hey, I like these charts, I like looking at charts, it's the way I want to trade, is they tend to find patterns everywhere. And you will all send us our charts, and we appreciate when you do for our comments or to Axel, and you find patterns everywhere all of the time, and that's really not the case. I think the more that you stay in the endeavor of charting, you become more and more selective over time. You know, I found really that any given chart probably only gives me 2 or 3 real strong possible chart patterns in an entire year, and that charting is not a science. It's an art. It's a craft. You can't just sit and say, well, I'm going to study a chart of a particular market until I come to some sort of conclusion. Charts don't work that way. The vast, overwhelming proportion of the time, an individual market cannot be understood on the basis of classical chart patterns. And the real key to chart pattern trading is to really find the patterns that matter. I like patterns that are extremely well defined. I look at daily and weekly charts, and of course I like it when weekly and daily charts agree, but I'll take a pattern on a daily chart even if it might not necessarily be as clear on a weekly chart. I too tend to like chart patterns that are in the 10 to 26 week range. I tend to stay away from patterns that are shorter than that. I will trade patterns that are much longer, on up to 1 or 2 years, and I'll have some examples of that. But there are some real tactical problems with trading these patterns that are multiple year, and that's basically how do you get in and how do you measure. They're tactically difficult. I like patterns in futures and Forex that give me a profit potential of $2,000 per contract and up, or in the case of spot Forex trades, that have the value of approximately 100,000 US dollars. Again, I'm looking for a trade that provides me with a profit potential of $2,000 per 100,000 US dollar valuation. And that way, if I do, let's say, one contract per 100,000, or I really look at it in terms of contracts per million, I do 10 contracts per million and can find a futures contract trade that delivers a $2,000 profit. It's a 2% return against my total capital on just that one trade, or 200 basis points. And so that's really kind of gives you a framework for what I look for. Ascending triangle, let me just point out a couple of them first. This is the kind of pattern that I like. 11-week ascending triangle in March 2017 sugar. Now, one thing that you've seen on Axel's chart that you've also seen on mine is we can spend months developing a pattern, 3, 4, 5 months developing a pattern, and the move is over quickly. And that's just the nature of charting, is that we wait a long time for a pattern to finally complete, and oftentimes the move is over in a matter of weeks, sometimes even days. And again, that's just the nature of trading chart patterns, but this was an ascending triangle. In this case, it was a continuation ascending triangle. The tendency of right angle triangles is for markets to break out the horizontal side. There are some cases where right angle triangles will break out of the diagonal side, but more often than not, the tendency is to break out of the horizontal or flat side. Here was just a classic, this ascending triangle in the dollar yuan, US dollar versus Chinese yuan, that began in early 2014, finally broke out in August of 2015. I mean, this is an ascending triangle that if somebody 100 years from now were to identify the 10 or 20 best ascending triangles in the century, this is one that would be on it. There are just so many things that took place during this. This was a wonderful, wonderful example of an ascending triangle. You'll see, and I'm really not going to address it, but you'll see along the way, in large bull markets that last an extended period of time, we often have flags or pennants or little symmetrical triangles that develop along the way that provide continuation patterns. Let me just move on to head and shoulders patterns here. This was a head and shoulders, in this case on the continuation chart of sugar. Those of you who trade futures know that there's some complication that comes into play in that futures contracts sometimes have very short duration for individual contracts. So we tie these contracts together as they expire into what's called a continuation pattern. I look at both continuation patterns and try to find timing and support from the charts of individual contract months, and they have to line up for me. But this was a head and shoulders pattern in sugar that developed over an extended period of time and reached its objective. I'm going to come back and ask Axel a question on targeting, so I'm going to not really comment on that, and I'll let Axel kind of tackle that here in a few minutes, and taking a look at his stock charts, how we develop our targeting. And of course, those of you who are members of the Factor Service know that I generally take profits at targets. Go on to another head and shoulders. This was an extensive head and shoulders, and this is one of those examples of a head and shoulders that's way beyond 26 weeks. In this case, it's the head and shoulders that developed over several years in the cocoa market, as shown on the continuation chart. And of course, there was a sizable move. And when I mentioned that some of these extremely long-term patterns are a little bit more difficult to trade tactically, the reason for that is you tend to get breakouts which might be a little sloppier. It's harder to find real concise, timely breakouts when we look at chart patterns that extend over a longer period of time period. Here's a head and shoulders that developed this year in Minneapolis wheat. There are basically 3 varieties of wheat that we trade in the U.S. We trade Chicago wheat, Minneapolis wheat, Kansas City wheat. They're all different varieties of wheat. Minneapolis wheat trades the highest quality wheat. It's a hard spring wheat. used primarily for pasta products, but here was a Head and Shoulders that developed in the March 2017 contract. Oftentimes what we will have when we get sloppy breakouts, as we did here, Axel mentioned the word, secondary breakouts, is sometimes you get a breakout and it fails and you just still have to hang with a pattern. My general rule is I'll try a big pattern 3 times, twice. If that's it, I won't go the 3rd time. I won't risk 3 strikes, you're out. From time to time, I may attempt a pattern 3 times, but it's not very often. But this was a case where finally this Head and Shoulders was resolved by another pattern, which I really like, and that's an ascending pattern. But here, again, you see 1, 2, 3, 4. We're 5 months in the Head and Shoulders, we're a full month in the ascending triangle, and we have a move that reaches its target in 6 days. And so you wait a long time for a pattern to really develop, and that is why trading charts really requires a lot of patience. If you're a chart trader trading these types of patterns, it is really a practice in patience, and then of course discipline. Eventually, when they break out, you've got to go with them. I have found over the years, people may ask, well, if you see this Head and Shoulders or you see a pattern, why don't you just get into it? And why wait for the breakout? Get in. And I can only speak to my own experience, and that is it's very frustrating. Oftentimes you get chopped up when you attempt to get into a pattern early. You get chopped up when the pattern finally goes. You're not aboard, and that becomes then an emotionally tough experience. Here's another Head and Shoulders that's really a very complex Head and Shoulders top in sugar. We had looked at the ascending triangle in the March contract, and this was a continuation chart, so it shows a little different picture. But what that ascending triangle that I showed earlier in the March contract was in this area. We subsequently formed a head and a shoulder, and if you look, the head and the right shoulder itself were Head and Shoulders patterns, and sometimes we get these extremely complex patterns. But this, again, is an example. Axel mentioned the term a launching pattern, where you can actually get a launching pattern where you see a pattern develop and something takes place in the final stages of the pattern, which will allow an early entry with a very well-defined risk point. Take a look at a couple of rectangles here. This is a rectangle in what we call the cable, which is the British pound US dollar forex cross. The nickname in the trade is the cable. We had, of course, Brexit, which we're all familiar with, the withdrawal from the euro mechanism by England caused a substantial decline in a very brief period of time in the British pound. But then subsequently we drifted sideways for 3 months, formed a near perfect rectangle. And again, you wait 3 months and you get a 3-day, 4-day trade. Not unusual. Sometimes you have to hang with the trade for quite a bit longer. I'll show an example of that next. But this was an example where a market forms a rectangle, and it's right in my time window, 13, 14 weeks. I love 13, 14-week concise daily chart patterns, which can also be visible on the weekly chart. And that's my bread and butter. Here's a rectangle again in the euro currency versus the US dollar, where we formed an extensive 31, 32, 33-week rectangle pattern. Axel had mentioned that we tend to draw our boundary lines off of real bars, not off of spindles. I do not mind drawing a boundary line right through a spindle. I feel no obligation to draw boundary lines off the extremes of a spindle. So I just want to draw a boundary, a pattern which makes the most sense, makes the most contact points. You notice here that we had a downside breakout of that rectangle, which proved to be an enormous bear trap, and of course we have gradually gone up since. But this is a market that has taken its time, and it's a market. It's a trade I'm in. It's a trade I've been in for quite some time. But this is an example of a pattern that develops over a long period of time, and still even now, which is almost a full quarter afterwards, we're still working our way toward a target. Here's another example of a rectangle in the cross between the U.S. dollar and the Turkish lira. 13-month rectangle that developed. That's again in that sweet spot of 10 to 26 weeks on up to a year. You get much past a year, and you just tactically have a very, very difficult trade on your hands. But it's an example of a market that ran its distance. I'll show one more example of a rectangle. This is on the continuation chart of wheat, and this is Chicago wheat. Chicago wheat, the wheat's trade in Chicago is the poorest variety of wheat. It's used for such things as Nabisco crackers and Keebler cookies and that sort of thing. But that's the variety we traded, where we came up and we formed this triangle pattern in wheat over a period of 1, 2, 3, 4 months, broke out. It was a tricky breakout, but eventually had a very, very strong brisk move in early July and fizzled out, and then did really what it's common in futures, more common in futures than the stock, where you get what I call a popcorn trade. The popcorn pops up to the top of the lid and goes right back into the pan. But that doesn't mean there are not good trading opportunities that exist in the process. Axel, I'm going to turn it over to you now. What I'd like to have you do is just kind of discuss how you establish timing of entry and how do you establish targets on these patterns.
So what we are looking at is basically the Edwards and McGee guideline of 3% threshold. So a stock should break out by a minimum 3% margin above the boundary, and this should be on a daily closing basis. So let's say we are looking at the BBVA chart. We have this a perfect horizontal boundary that has been tested several times. We are talking about 6.6 levels. A 3% margin above that will give us this gray dashed line, and we want to see the stock closing by closing on a daily basis above this line, which is the 3% margin. So this basically confirms the breakout from the chart pattern. And when we're looking at price targets, most of the chart patterns would be, we will be taking the width of the chart pattern at the widest point. So with, for example, head and shoulder bottom, we're looking at 6.6 and the lowest part of the head, taking that distance and adding it to the breakout point at 6.6, and that gives us 8.6 chart pattern price target. So for example, in the case of, if we look at this ascending triangle, we take the widest point of the chart pattern from the upper boundary to the lowest point of the first minor wave. So we take this width and add it to the breakout point, which gives us 76 levels as the chart pattern price target. With rectangles, we don't have the widest part because each part of the chart pattern is equal width. So we take the width of the chart pattern and add it to the breakout point, which gives us the chart pattern price target, that is 7.8. With cup with handle chart pattern, again, we want to take with the head and shoulder bottom, for example, we take the width between the head, the lowest part of the head, and take the boundary line and add that distance to the breakout point, which gives us the chart pattern price target. With cup with handle, instead of taking the width of the handle part, we're taking the widest point of the chart pattern, because these cup with handles are a derivative of a head and shoulder continuation. So imagine this chart pattern without the left shoulder, but having the cup and the handle. So we have to take the widest point of the chart pattern, which is this distance, the lowest part of the cup and the boundary line, and add that to the breakout point, which gives us the cup with handle chart pattern price target.
Hey, thanks.
So
yeah, that was great, Axel. Hey, could you show a few examples of markets that you're looking at right now? These are markets generally that you've shown, which provide wonderful examples of these patterns that have run their course, and that is always needs to be our standard of reference in really trying to compare what we look at today and compare them to what we know have been good quality patterns in the past. That's kind of our standard of accountability. But if you'd show a few markets that you're looking at right now that are early in the breakout or perhaps haven't even broken out yet.
Yeah, sure, Peter. We have a lot of great rectangles and ascending triangles that are building up and breaking out at this point. So I will start with one of the charts that I featured. This is Telephone Brazil. It's an ADR listed in the New York Stock Exchange, but I featured the Brazilian listed stock and the ADR in one of my reports. Both of them are clearly breaking out from major horizontal boundaries. So here we have this year-long ascending triangle that is that tested the upper boundary for several times, and the breakout week takes us above the boundary line. So 15.55 was the boundary, and now we have this chart pattern price target of 19.3. Breakouts from these type of lengthy consolidation periods usually are followed by strong directional movements. So this is one of the charts that is in the process of moving to its chart pattern price target. The second one is still pending for a breakout. A perfect ascending triangle, again a year-long ascending triangle. Here we have this horizontal boundary at 88.5. This is a stock post-holding. It's listed on the New York Stock Exchange. Ascending triangle price target is at 110 levels. So the breakout still hasn't taken place, but we are pending for a decisive price action on this ascending triangle. The next one is a Japanese company. I have featured this in the previous reports, and then I highlighted it again because now the stock is making another attempt for almost the fifth time to breach the upper boundary at 1915 levels. So this is a 6-month-long ascending triangle that if we see a clear breakout, the price target will be 2260 levels. This is a Japanese industrial company. Another one, as we have discussed the secondary completion, this is a perfect example, which I have highlighted in the Tech Chart Study section. Every week I'm trying to discuss different concepts in charting and technical analysis. So the premature breakout and false breakouts were the discussion in the past week's report. So we had this Royal Dutch Shell price chart forming a year-long ascending triangle. Here we had this premature breakout for a week, and then the next couple of weeks the stock fell below the boundary line, and now we are seeing a secondary completion price breaching the 3% Edwards and McGee guideline level that we have placed for confirmation of the breakout. So this stock is basically going into the alert section. It's a stock in ADR listed on the New York Stock Exchange, an energy company with a price target of 67. Another ascending triangle, 6-month-long ascending triangle that is breaking out. Norfolk Southern, it's a Dow Jones Transportation company with a price target of 140. This chart pattern is being completed, and the price for the past 2 weeks moving higher from this chart pattern. Now we move to the rectangles. Rectangles are my favorite chart pattern. Woodward, a NASDAQ listed industrial company, formed an 8-month-long rectangle. The upper boundary was tested several times. I like these type of setups. And now here, for the past 2 weeks, there's an attempt to clear the resistance at 71.5. Our price target is at 78. So this is a perfect rectangle that has taken 8 months to build, and now it's on its way to the price target. Another rectangle that is breaking out this week, so the weekly close is going to be also important, but on a daily basis we have seen the confirmation. A 9-month-long rectangle, SkyWest airline company, listed on the NASDAQ, an industrial stock. This 9-month-long rectangle is being completed on the upside. Here you can see a 3-year-long uptrend. One of the things that I look at is the rectangle chart pattern usually acts as a bullish continuation or a bearish continuation in the overall trend. So if we are seeing an uptrend and we see this rectangle chart pattern forming, there is a higher possibility of this thing completing on the upside as a bullish continuation chart pattern. So that's why I put this on the watch list for a possible breakout on the upside. And then another rectangle which I will be featuring in this week's update is ITT, listed on the New York Stock Exchange, an industrial company forming a 9-month-long rectangle, and this week we are seeing this breach of the upper boundary, 42.75 levels. The rectangle price target is at 47.65 levels, so we're just probably at the beginning of this breakout that's taking place. If you look at this, the bigger picture that comes from 2015, the stock has been in a clear downtrend. Here we can argue that this was a symmetrical triangle that acted as a reversal. So the breakout came, and then we have seen this massive consolidation building. So this consolidation, if you look at in the bigger picture, is basically a preparation for continuation higher after this breakout has taken place. So if you look at the continuation chart patterns, we would like to understand it in the bigger picture. What is the stock doing? So first the breakout comes, and then the consolidation, and now we're seeing another upward thrust possibly in the next couple of weeks. So here is an interesting one that I would be featuring this week in this week's report. Is a 9-month-long rectangle. I don't know what implications it might have, but it's an interesting ETF, ProShare S&P 500 High Beta ETF, S&P 500 High Beta ETF, forming a 9-month-long rectangle with the upper boundary at 38.6, price target 41.5. The upper boundary was tested several times, and now this week another attempt to breach the upper boundary. This is a Japanese company, 2-year-long head and shoulder continuation, a beautiful chart pattern with the horizontal boundary tested several times. A breakout can really generate a nice directional move on this stock. I like these head and shoulder continuation chart patterns that break out to all-time highs. So when we see bullish continuation chart patterns that break out to all-time highs, this is the path of least resistance, because there is no more resistance and the stock is clearing almost all the highs that has been tested in the past. Here we have another name from Hong Kong. Emerging market stocks have been doing well. Chinese equities have been doing well. There was a nice year-long head and shoulder bottom that formed on this stock, MGM China, an casino entertainment company. The breakout took place, a pullback, it reached its price target, and then for the past 7 months, it has been building this right shoulder of a major head and shoulder base formation. So as we have discussed the launching patterns, this 7-month-long ascending triangle is possibly acting as a launching pattern on the upside. First target is 22.3 for the ascending triangle, and then we have the head and shoulder bottom price target, which is at 27.5 levels. So this is a major base building process with several chart patterns confirming each other on the upside. So basically these are the chart patterns that I'm looking at right now, Peter.
Okay, great. Well, hand me over the screen here. I'll run through a few of mine here, Jolene. Thanks. Let me make, I don't have very many, and I'm going to run through them fast so we can get to questions here. But I want to make a couple points first. You'll notice both on my charts and as well as Axel's in our approach to classical charting, we're not looking for stocks to double, triple. We're not looking for huge home runs. I mean, I build my performance record in bits and pieces. You know, we're looking for markets that'll move 10, 15, 20, maybe 25% in underlying value, and that's it. And that I have found is really the best way over time for me to put together a good performance record over the course of a year, is to catch 7, 8, 9, 10 of these type moves and then try to break even on all my other trades. And I've written quite a bit about that. Factor members are well aware of that. I'll just show you a couple of patterns I'm looking at, factor members will find this familiar, and this is the cross between the British pound and the Japanese yen, which broke out here last week, and it's a trade that I own. On a trade like this, for instance, the pound's more valuable than the U.S. dollar. It's not a U.S. dollar cross, so it's U.S. dollar neutral. But because the pound is extremely higher value than the U.S., my typical sizing on a trade like this might be 300,000 pound yen per $1 million of underlying capital, or 30,000 pound yen per $100,000 of trading capital. So that just gives you an idea of timing. I don't use the 3% rule because futures and Forex are very different than stocks. I agree with Axel on his 3% breakout rule, but think about this. A 3% breakout rule in gold would be equal to basically $40 per ounce. And the COMEX contract, that's $4,000 per contract to even say it's broken out. So I tend to use breakouts in futures and Forex in the area of 0.75%, somewhere between 0.5% and 1%. It depends how well defined the boundary line is. And also I pay attention to closing price confirmation. So oftentimes I'll take half of a position on during an intraday breakout if the boundary line is clear, and I'll put on half once the market closes and gives me a confirmation. Here's another pattern I'm looking at, which is a 4-month rectangle in cocoa. This is a continuation chart, but it's pretty much the same chart when you look at the individual contract months. But there's a trading range that I'm looking at to become resolved in order to take a position. This is feeder cattle, a trade that I became involved in just this week. It's a trade I featured in last week's factor update, giving it a couple different interpretations as possibilities. That of a continuation head and shoulders pattern, left shoulder head, right shoulder, or because the right shoulder was more extended than the left shoulder, I thought that there was also a possibility it could have been a symmetrical triangle top. But we broke out, that solved that along the trade, and on a trade like this, generally I'll try to move my stops to break even as quickly as I possibly can. This is a trade I think will be one of my better trades, or could be in the next year or two, and that's the short side of the Euro-Swiss rate. Those of you who are familiar with global rates knows that the Swiss National Bank has set their yield, their debt yield, at a negative interest rate. If you're holding Swiss francs, they're charging you 75 basis points a year to be holding that currency. And I just can't see how a central bank can maintain a negative interest rate policy forever. There's been a negative interest rate in the Swiss since early 2015, and the process has formed a massive but very clear descending triangle pattern. I'm waiting for the Swiss National Bank to come out and post a daily rate of minus 68, 67 basis points, and I will take that as a sign that they're beginning to cave in on their negative interest rate policy. Here's a 13-week ascending triangle in the Taiwan index. This is traded in the Singapore exchange. And just a point, on my charts as well as Axel's, traders who limit themselves just to U.S. markets or just to European markets are really missing a world of excellent opportunities. I mean, there are excellent markets all over the world. I know I trade a number of Axel's global stocks, and I use Interactive Brokers for that. I used to use Bank of New York Mellon as my prime broker. They exited the futures and Forex business, but there are wonderful opportunities in many of these major markets, and so those of you who are inclined to spread your wings in other markets, whether you're in Europe and you want to look at Asia, whether you're in the US and want to look at Europe or whatever, there are good opportunities. This is an ascending triangle. I have stops in to buy this. Market should break above the 400 level. and go with this breakout looking for move 415. And finally, I'll take a look at Australian 3-year bonds, which are forming a very significant head and shoulders top on the weekly chart. But again, this gets you an example of an extremely long pattern. This is a pattern that dates back to early 2015. So as opposed to 12, 26-week patterns, which are very tight, once we get into weekly charts, we get into markets that represent very difficult tactical issues in terms of trading. So that's kind of my list of markets I'm really keyed into here. Jolene, I am going to hand it back to you, and we can start going through some questions, and you can take the screen away from me. Yeah, absolutely. Do I track price of rice separately, as included in the grains that I'm already tracking? Yeah, rice is a grain product. It's not a row crop, but it's a grain. I track it. U.S. rough rice is probably in the strongest position technically of any of the U.S. markets. Let me just quick jump in here too, Jolene. We'll give you an opinion on a particular market or stock if we have it, but we're not going to be able to jump to the charts of those at this point in this webinar. It'd just be too complicated to jump back and forth between my Trade Navigator stocks charts here in the U.S. and the MetaStock platform that Axel has in Bulgaria. So, we'll answer questions about individual markets, but we're not going to be able to show the charts of it. So, anyway, that's my answer on rice.
Yeah. Okay. So the question is, how important is the volume when price break out from the chart pattern? Is it more reliable with higher volume, in your opinion? So this is a common question that I receive from members via email, and I try to answer almost all of them. So here is one thing that I'm doing, because I'm looking at global equities, and this can be in the emerging markets as well. And as members know, I've been working in the UAE market and looking at many emerging and frontier markets. And I have realized that volume is an important part of chart analysis, but when it comes to breakouts, sometimes the stocks can break out without volume, and then the volume can come afterwards. Or we might see a high volume activity around the boundary lines. It can break out without volume, but then again volume can pick up. So just because of there is no high volume at the breakout, I'm not eliminating it as a confirmed breakout. So this is volume is basically not part of my decision-making process to confirm a breakout. But of course, an increase in volume is always better for breakout confirmation.
Okay, let me just take this, pull up a chart on Interactive Brokers, big chart. Do you get different breakout resistance lines? What's the official chart? There's going to be a different answer between Axel and I in this on stocks. But my official charts are basically Trade Navigator. I trust their data. On futures and Forex, I absolutely trust their data. They're incredibly impeccable in terms of having good data. I don't trust Interactive Brokers charts. I mean, I don't really even look at them. My stock charts are a little bit different than Axel's, and I'll let him talk to that. He'll have a pattern, and I won't have the same pattern because my charts treat dividends a little bit differently. I think the MetaStock stock charts are more reliable than the Trade Navigator stock charts. I'll let you pounce on that quickly, also, Axel.
Yeah, sure, Peter. So what's happening with the stock price charts is there's a different way of calculating price chart information, incorporating corporate actions. Some charts are adjusted with dividends, some are unadjusted with dividends. So what I'm looking at is when I go through basically every week close to 5,000 charts, I don't have the time to go back and forth and check different platforms if this stock is adjusted or unadjusted. What I look at is there a clear chart pattern boundary that the stock price has respected in the past? If there is a clear chart pattern boundary, that meets my criteria as a clear horizontal boundary that has been tested several times, I take this chart as a great trading opportunity or a chart that I can feature on the platforms. Whereas if you go back and check, for example, the Bloomberg terminals, the exchanges, the meta stock, you might see some differences between the same chart pattern being calculated and featured. So this is what I'm following at this point. I'm looking at meta stock, Thomson Reuters icon data, and I believe that they are following a good process because most of the charts that I have checked, New York Stock Exchange and NASDAQ on their website, were matching the meta stock charting platform.
Okay, since I traded more in India, can you please tell me what is the strongest sector that can be played for Nifty move up to 11,250? I can't. I don't. You have any opinion on sectors in India, Axel?
Not the sectors, but what I'm seeing is the small caps are stronger, and they are setting up for major breakouts, whereas some of the blue chips are lagging. This is what I'm seeing in India equity markets right now. This week's report will have some nice India equities also featuring those setups that I'm focusing on.
Yeah. Hey, thanks, Axel. This question's yours.
What is risk management, trade management rules of thumbs do you apply when trading? So the first thing that I look at is basically if the chart pattern is a clear chart pattern, am I seeing something that is not there? So a chart pattern with clear horizontal boundary, a well-defined boundary, is the first rule of thumb that I apply. The second one is at the entry, being too early versus being on time. That means, am I looking at the 3% breakout guideline on a daily closing basis? So this is another thing that I follow. So those are the two important things that I look at. Basically not being early, seeing the real confirmation, and identifying those chart patterns that are reliable and having a clear horizontal boundary and seeing a major breakout from those.
Thanks, Axel. From observing your trade recommendations, you seem to have a different time frame for your deal trade setup, 10 to 26 weeks versus 4 to 24 months. Would be curious to understand if that's a function of the different markets you trade or just different experience with reliability of time frames or something else. I mean, I can answer it for myself. Axel might chime in. I think it's both. I mean, my sensitivity is to a shorter time period. I think, frankly, because I'm trading stocks, or rather than stocks, I'm trading futures and forex. I think that the market behavior there is a little bit different, and I would agree with Axel that when we're trading equities, that it's that little longer time period probably works better with equities. So I think it's a function of the markets, but I think it's also a function of kind of our own personalities in how we've nuanced our own approach to trading. I don't know if you have anything to add to that, Axel.
Yeah, I agree with you, Peter. For example, when I look at charts, I load the charts from, for example, right now from 2013, so a 4 or 5 year old data on a weekly basis. So when this chart comes in front of me, I am clearly able to see a 5 to 6 month long chart pattern building on this chart, price chart, versus a 2 month long or 3 month long chart pattern. So I'm able to identify those opportunities better if I have a little bit longer term time frame. And when you look at, for example, more emerging market charts, the volatility can be more. So you want to see a little bit more long-term breakouts and try to stay with those trends.
Yeah, thanks, Axel. Okay, neither of you use volume in your analysis to confirm breakouts. Can you talk a little bit about why you don't use it, especially for stocks? Axel, as volume is more readily available compared to Forex. Let me speak to that first. I mean, volume is not available in spot Forex, and spot Forex is by far a much more massive market than the futures markets. While the futures markets are very sizable with a lot of liquidity, futures markets are not the spot markets, and spot markets tend to be over the counter, so we don't have volume figures. I look at volume, I just don't feature it. I mean, my experience with volume is huge slugs of volume either represent stopping volume or starting volume. I will look at volume, but futures contracts are very different than stocks. An individual stock has a certain amount of stock in the float, and so the volume of a stock is all relative to a fixed number, and that is the total number of shares that can be traded. That's not the case in the futures market. And so I found some of the rules on volume to be a little bit different in futures. So I tend to pay more attention to patterns than I do than Axel might to stocks. I think Axel probably pays more attention to volume than you might think. It's just that he's not featuring that as much as he's featuring the geometry of the market. You might want to add to that, Axel.
Yeah, I agree with this, Peter. I look at volume, but in terms of featuring it, I'm not making it a decision-making tool for confirming breakouts. It's good to have increase in volume when you see a breakout, but it's not a must. As I have mentioned in the previous question, you can see a breakout without volume participation, but then the volume can pick up in the later stages of the trend. Another issue is, for example, there are lots of equity funds that are indexed to benchmarks. Okay, so let's say we have a big holding in this MSCI index. MSCI comes out and makes a major change that by increasing the weight of it or reducing the weight of that stock. So they give you a time period of 30 days to take action, and during this period all the funds are taking action to basically make allocations, reduce their weighting and increase their weighting. So these type of volume patterns, volume movements can also disrupt the volume pattern that you're seeing during the chart pattern. And also when you're looking at weekly time frames, that week's volume might not be very meaningful versus the daily breakout volume. So a lot of negatives versus the positives when you're looking at volume with equities globally. When you're looking at emerging markets, when you're looking at light volume markets in Europe.
Okay, can the right shoulder and gold chart morph into abbreviated one and thus making the breakout powerfully? What is the reason for you to have a head and shoulders to be symmetrical in the chase of gold? Yeah, I wish I could show the chart. Those of you who get the factor kind of know what this question refers to. It could be an abbreviated right shoulder. I don't think it will be, and there's a couple of reasons for that. One reason is the commitment of traders. I mean, the commercials are just building a huge short position in gold, and I would anticipate that should the market advance back toward that 1350, 1370 area again, it would become even larger. It probably would become record. And I just think the possibility of having a blast off bull market in gold from a level where most of the specs have bought all they can buy is very unlikely. The other thing is that gold just, in my opinion, is the best charting market in the world. It is the best example of classical charting patterns. And because of that, I tend to think that gold should follow the rules a little bit more than some other markets. And so not only is it stunted in size, it's also stunted so far in duration. And I just think gold is going to drift sideways to down, probably form a huge symmetrical triangle on the right side. Again, looking for lows in the December to March area, lows in the area of 1200. in sometime next March or April, if gold market still has not broken out to the upside and cleared 1400, then I think we have the making of a real humdinger.
A general question concerning the neckline of Head and Shoulder formation. The neckline boundary can be horizontal and diagonal as well. Is that of any significance? Yeah, it can be diagonal, but what I'm looking at is I like to feature those horizontal Head and Shoulder chart patterns because it's much easier to identify on the chart when you're looking at several charts during the day, during the week. So these horizontal boundaries are clearly visible, and also the breakouts are, I believe, more reliable from these horizontal chart patterns.
Okay. With regard to the future, the successful patterns are 12 to 16 weeks long. In light of having to wait for the right patterns as a trader, are you not significantly limiting yourself in building significant equity due to fewer opportunities that emerge? I think it's actually quite the opposite. You know, my experience is that the traders who really build the largest equity over time tend to be traders that trade fewer times and wait for better opportunities. I just have never equated, while active trading can generate a nice cash flow, I don't think it can build wealth in the same way that waiting for good opportunities and staking a larger bet takes. So I think I come down on the other side of that, is that if a person really wants to build significant equity, the answer to that is wait for significant opportunities. You know, my experience is that I refer to trades that are highly asymmetrical in their reward to risk ratio. I can't really paint a picture of that. I try to do so in my writing, but my experience is there's fewer than 10 of those a year, and you can't force those to be there by just trading more. And so that's where I come down. I don't know, Axel, you have anything to add to that?
No, I think you have summarized it very well, Peter, on this one.
What do you see as the pros and cons of using it? Well, CFDs are not a U.S. Really option. CFDs are not really used actively in the U.S. So maybe you want to take that, Axel.
Yeah. So CFDs, yes, I utilize them in equities, especially in foreign stocks. When you are trading in foreign equities, you have the disadvantage, or maybe it can work in your advantage, but it's something that you have to worry about, is the hedging. So with CFDs, you don't have this. It's just the carrying cost of the, basically the money that you're paying for the leverage will be charged on the CFD, which I prefer to go with versus owning the equity and trying to hedge that exposure. So there are several CFDs on global equities and commodities and even ETFs, but from my understanding, US investors are not allowed to trade those. I'm not recommending using it because it's a leveraged instrument. You have to do your own due diligence on it, but it's an instrument that I utilize from time to time when I look at European equities, Japanese equities, and Hong Kong equities.
Is the flag pennant correction after a previous move? Where do you identify either the set? Where do you ideally enter and set the stop loss? Well, let me just answer that first. I prefer when a slight correction takes place that correction is a pennant, because a pennant can have a horizontal upper boundary, whereas a flag tends to slant. And so I tend to stay away from flags just simply because I'm taking a position through a diagonal pattern which has the tendency to morph out, and the probability of success is less. But I do like strong markets that then form up, and that's where I'll take an exception to the 10 to 26 week pattern. Is if we have a strong market and come in and form a 3, 4, 5 week pennant, that for me is an opportunity to extend my my leverage. In those cases, again, I'm hoping to have clearly identified horizontal boundaries on those small consolidation periods. I wait for the breakout of those, and generally I try on those smaller patterns to have extremely tight stops and move those stops to break even as quickly as possible. The problem with those is when you extend leverage and you're pyramiding, it takes a smaller correction to actually put your whole position into risk. So I will trade pennants that are slight corrections to strong moves, but again, on the condition that that'll have a horizontal, preferably have a horizontal upper boundary. You have anything to add on that, Axel?
No, Peter, on this one, no.
You mentioned the tactical challenges of trading 1 to 2 year patterns. Would you mind explaining how you address these challenges tactically? Yeah, that's a great question. Thank you for asking that question. When you have a big pattern, especially, it's almost impossible to really enter the market if there's a strong trend that takes you through the upper boundary, because there's just really no logical place for you to risk the trade. I mean, buy a breakout of a two-year pattern when the market charges through the boundary is very difficult to do. So what I hope happens when I see those patterns is the market just stutters at the boundary. You have that 2-year pattern, but in the process of moving up to the to the boundary line itself, the market checks up for a week or two. Or 3, and just maybe even forms a flag or a pennant at that upper boundary that just gives you a little bit more clarity on your boundary line. That really then offers me a better tactical opportunity to enter that trade. The only other option is you let that pattern, and I think the 3-year bond in Australia is a perfect example. That's a difficult short, but what I would want to see in a pattern like that is to see an absolute confirming closing price confirmation, and then try to short it on just some sort of a retest where I can have a realistic stop. Is you let it complete, let it retest for a day or two, take a shot at it, and hopefully put in a stop. But tactically, they're just very difficult patterns for me to trade.
Yeah. Do you agree with Peter that profits should be taken when target is met? Yes, I agree with that. There's one different thing with the equities. When equities break out from a 2-year long chart pattern, there's a higher tendency of these things to turn into major trend periods. So even if you take partial profits at the price target, I might like to continue holding part of the position with some kind of trailing stop loss.
Yeah, let me just add to that, Axel. What I have found out is when you have a very narrow range rectangle, we're talking about a rectangle here, and you have a very narrow range rectangle that represents maybe 8 to 10% of the value of the underlying that extends for a considerable period of time, is very tight. A general rule of thumb is that rather than the measured move, you probably get 3 times the measured move. And so I'll be very generous with my, it's like the Euro US right now. While the target's 124, I think more realistic is probably up in the high 130s area based on the fact we came out of a rectangle representing less than 10% of the value.
Do either of you have a real preference for bars over candles, and why? I used to look at bar charts before, and I started seeing more advantage of the candlestick charting because even though we're looking at chart patterns, at major support and resistance areas, we might see those few reliable candlestick chart patterns that form like the bullish engulfing or bearish engulfing that might suggest a reversal or a doji forming at a resistance that might suggest that the move is possibly finding a resistance. So the candlesticks have a little bit more advantage versus bar charts, in my opinion.
Yeah, I agree. Next question, Jolene. Peter, do you also watch bar by bar in order to identify patterns more accurately, kind of tape reading? I understand you trade the breakout, but are you more alert when, for example, bars are more narrow range at the moment you think breakout occurs? I mean, that's a good point. I think the market tightens up right at a breakout. That's a good sign. But again, for me, the challenge is I know myself too well, and I know that if I pay too close attention to markets during the day, it brings my emotions into play more than I want them to. And so this is a good question, but for me, it's a question that's all relative to what happens at the end of the day, and I look at the chart and what it looks like. So I do look at bar by bar, but I look at bar by bar after the close.
Where do you place initial and subsequent stops on breakouts? What do you consider too late a breakout entry? Well, with stop losses, this is basically a trading tactic that every trader would implement according to their own plan, according to their own risk profile, position sizing, holding period. What I do is with the TechCharts membership service, I'm basically highlighting a level for chart pattern negation. So this is usually, for example, if you're breaking out of an ascending triangle, at what point this ascending triangle will not be valid anymore? At what point would I look at this chart pattern in a couple of months and say that this was the point where the chart pattern was negated? So this is usually the minor low before the breakout takes place, but this might be a little bit too wide of a stop loss for some people. That's why it is highly recommended that everybody use the risk management tactics that would basically apply to their own trading style. And what do you consider too late a breakout entry? A breakout that is above 3%, a daily close above 3% is the confirmation we are saying. But if the stock is, for example, breaking out on a daily basis by 6-7%, I don't think it would be. It will actually depend on the range that is breaking out. If it is a very wide range, and you have a big upside potential on the chart pattern price target, then a 6% might not be a runaway movement. Whereas if you are looking for a 10% upside potential and you have already given up on the 3 to 4% of that margin, then it might be a late entry. So it will depend on how much upside potential you have and where the stock is closing on that day above that 3% threshold level.
Yeah, that's a good. I'm not going to address that one because it's awful complicated for me. Let's use this kind of as our final exit question, Jolene, and then we're going to kind of wrap it up. Thanks for so many of you who stayed with us, and we didn't get your questions, and but we can only do so much. So there are so many great trade setup ideas provided for you in your chart analysis. Practically, when managing capital, are you constrained by the number of trades that you can take? How can you manage the process of selecting the best trades? What criteria do you use to define those? That's a great question. Let me take that from a future standpoint first, Axel, and then I'll let you handle it from the standpoint of global equities. Yeah, there are a lot of great trade setups, but keep in mind I trade leveraged instruments, and so I really never run into a situation where I can say I can't afford to put anything more on. I don't have any more margin money. I mean, at best, when I'm really, really extended, I'm probably a 20% margin to equity. That is 20% of my nominal capital is sitting with exchange clearinghouses to hold the position overnight. So I'm yeah, almost always at least 80% in cash. So I don't have this problem where all of a sudden I'm constrained by the number of trades that I can take. However, I do constrain myself when we're dealing with trades that have a high degree of correlation, and that is I want to be short bonds, 10-year notes, 5-year notes, 2-year notes, Euro-dollar futures, etc. I'm well aware of the fact that I can't do that. I just don't want to be that exposed to highly correlated stocks, and so generally speaking, I limit the risk on an individual trade to usually less than 1% of my nominal capital. That's my risk. But if I'm trading highly correlated instruments such as gold, silver, bonds, notes, the dollar index, euro currency, what I'll try to do is keep myself in composite to less than 2% of risk. Now, which ones is the best for me? Well, that's determined by what pattern is the clearest and which one breaks out first and which one looks to be the strongest. When I am long in a category, I want to be long the strongest. When I'm short in a category, I want to be short the weakest. And some traders say, well, I don't want to be long the strongest because it's gone up too fast. I want to pick one up that hasn't really gone yet. And I've just found that always the best policy is try to be long the strongest. And so I look at which one's breaking out first, which one has the best pattern, which pattern offers me the opportunity for the best defined risk. And so that's how I take it. I'll let you answer this to close us up here, Axel.
Yeah, sure, Peter. Well, I like to go with the stocks that have clear horizontal boundaries first. So I go with the rectangles. And then second, I look at those symmetrical triangles if I would like to trade those. For example, the symmetrical triangles that have longer term duration would be my preference. Those who have been following the Thailand breakout, for example, would remember that this index broke out of a 3-year long symmetrical triangle with that perfect launching pattern, which was an ascending triangle. So these type of longer term duration symmetrical triangles I would like to add. Also using wider stops, limiting the position sizes would allow me to add obviously more positions to my portfolio. So even though I have 10 to 15 great looking charts, maybe 5 or 6 of them would be a really good candidate to take from the horizontal boundaries.
Yep. Well, in your situation too is when I trade cash, I don't trade or stocks. I don't trade it on margin, and so I can quickly run out of the number of stocks I can be in at any given time. It's really only 7, 8 equity names pretty much will exhaust the capital that I have set aside to trade global equities. And so, there's a constraint on a non-margin stock trader that does not exist for a margin trader. So anyway, hey, thank you all so much for joining in. We'll try to do this again. Jolene would love to have your feedback. Has this been a useful time for you? Is this something you'd like to see us continue to do jointly or whatever? So please provide your feedback. And thank you, Axel, for joining us. I know it's getting later in the day, your time, and you've got family stuff to attend to. And thank you, Jolene, for all of the work you do in putting these together.
Thank you, Peter. Thank you, Axel.
Thank you, Jolene. Thanks for everyone joining.
Yep. Thank you. Thank you everyone for joining us again. If everything recorded properly, a recording of this webinar will be on both websites next week. And like Peter said, if you have any feedback, I would love to hear it. You can reach me on either one of the websites under the support tab. If you click on contact us, that email comes to me. So if you have any other questions for Peter, I'll try to get those answered for you. If you have questions for Axel, please, you can fill that out there as well under the contact us on the TechCharts website. And thank you again for joining. I hope you have a wonderful rest of your day and a fantastic weekend. Thank you.